Welcome back to Tax Hacks with Alli. I'm Alli, your host. I'm a tax professional, and I want to share with you what to do when you owe IRS and you can't afford to pay them what they want you to pay them each month. So I covered in the last two videos should you file if you owe? Yes, you should. And how can you pay if you can't pay it all right when you file? You can do a regular payment plan. It's called a streamlined payment plan, where you take your balance and divide it by 72 payments, and that's how much you need to pay per month. That'll keep IRS happy, keep them off your back, and will also, get that payment headed towards the right place. You get that balance paid off. Now, what happens if you can't afford the minimum amount that they want you to pay on this balance? So from time to time, things come up, you lose a job, you have unexpected expenses, or the balance is just too high. So in my last example, I used $2,000 as a balance due. If you owed $2,000 to IRS, they would accept a payment plan of $30 per month. Well, let's add a zero, and all of a sudden you owe $20,000 to the IRS, and they want a payment plan of $300 a month, and you can't do it. You're going to end up, not paying your rent or not eating and clothing your family, and that's not acceptable. You cannot do that, and IRS cannot require you to do that. And so they have something that's called a non-streamlined payment plan. And with this non-streamlined payment plan, you are able to call IRS and explain to them your financial situation. There's a specific form. It's called a 433A. So if you go on to irs.gov and you search in the search bar 433A or 433B, that's going to bring up the form and the instructions. And you fill this out, and pretty much it collects all of your financial information. How much do you make per month from whatever income sources you have, whether it be alimony, unemployment, W-2, small business, pensions, Social Security. How do you get your income each month, and how much do you get each month? And so if you have a regular source of income like Social Security or W-2 or alimony, something that is the same amount each month, you'll fill that in. If you're self-employed, there's an additional form you're going to need to do to kind of average out what your self-employment income is, and you will have to submit some additional information to them to prove that out. So you start with your financial income coming in, and then you work through your expenses each month. Now, IRS is going to give you a deduction, it's an allowance where it is for all the necessary things that you and your family need. So they're going to look at your prior tax return and see, are you married? Are you single? Do you have children or dependents on your tax return? So if you are single, it's just going to be for you, and you're going to let them know how much your housing costs, your utilities, your rent, renter's insurance or homeowner's insurance, property taxes if you're a homeowner, how much your car loan is, if you have a car loan. If you don't have a car loan, how much it costs to just maintain your car that's already paid for. So you might have an older car that's paid for, but it has repairs that come up more often, or how much it costs for gas to get to and from work each week. So we're going to do this by month. So the monthly amount you're spending for gas, for car insurance, for repairs, for registration fees, your housing expenses, your food, your clothing, medical expenses. So if you have some regular prescriptions, maybe you've got a prescription that's $450 a month. I mean, I hope not, but that happens. Or some doctor's bills, something going on there. You also can include your credit card payments, your minimum fees. Now, depending on where your expenses line up with the national average, they may not have any additional questions. If your rent and utilities and car ownership and food and everything kind of is pretty modest, and then they're going to say, okay, that all sounds reasonable. And we see that you bring in, $2,000 a month and your expenses are $1,900 a month. And so we only have $100 left. So we can't make you pay the $300 that we would like you to pay. We'd like you to pay the $300 a month on this $20,000 bill, but we can see that you only have $100 a month left over after you pay all your necessary living expenses. And so we will allow you to set up a payment plan with us for $100 a month. And that payment plan is good. They can set it up then as long as everything kind of fits within their standards. And then you'll be on the hook for $100 a month instead of $300. Now, you do have some other requirements there. You cannot add a new balance onto your tax debt, or you're going to have to call and go through that example again. And they may issue a lien on your credit. So that would be on any of your personal property. Like if you own a home, there would be a lien on that property. And before you sell it, they would want to be paid on their debt. I've got some more information for you about what happens when we're in these non-streamlined collection situations, this non-streamlined installment agreement, where we're not paying the amount that they want, and we're really not going to pay that debt off because of how the interest and penalties end up. So stick with me, come back for the next video, and I'm going to talk to you about the collections process as a whole and how that looks when it doesn't look like we're going to be able to pay this debt off. We're not fitting into streamlined conditions that will allow us to get it paid off. All right, well, I hope this was good information for you and helpful. I'll have some more information for you soon on what to do when you don't fit into the normal box of payment plans with IRS. See you soon.